What's up, everyone? In this video, we're going to talk about the current market conditions and what we have to do as traders to adapt to fit the current conditions in order to trade better, make more profits, and find consistency in a market where I see a lot of people struggling. Now, how do I know this? I get tons of messages on my Instagram every single day for non-Investor-Trade course members. If you're watching this video and you're not following me on my Instagram, I'll post a link in the description below to do so. However, based on the engagement on my Instagram, a lot of people are struggling to find setups. A lot of people are struggling to find consistency, and they're not taking as much of high quality trades than what we've seen maybe 2-3 weeks ago. So this video is going to explain how to adapt to these conditions, how I'm looking to trade them moving forward, what I'm looking out for, and the best instrument to trade in order to adapt, fit with the market, in order to make better profits and take better trades. Any successful trader will agree with this, whether you're making good profits now, whether you're struggling. The market is constantly changing, and as a trader, to be profitable and to build consistency, you must adapt with the market. The market we saw yesterday might not be the same market we're going to see tomorrow, or the market we saw last month might be different from what we're going to see next month. It's constantly changing, and that's the beauty of a marketplace. It's constantly changing based off the participation in the market. Now, not a lot of people know this. Not a lot of people have the light bulb in their head to agree with this, but how I view the market is it's a storyteller. Its main purpose is to facilitate trade and advertise price. So if something is advertising or giving us information, then it's a storyteller because it's providing us with things that we do not know unless the market tells it to us. So as a trader, we must comprehend the story that the market is telling us. I have a video in the course about this, and I say this in my other YouTube videos about how the market is like the four seasons, and you're not going to go outside in the summertime with a winter jacket on, and when it slowly starts to get cold outside and the winter starts coming, we start seeing snow, 10, 20 degree days, you're not going to go walk outside without a shirt on. You're taking that information of what it's providing you, and you're adjusting and adapting to fit those conditions. We must do the same exact thing with the market, or else we're going to struggle, we're going to get hurt, and we're not going to trade the right way. Now, the main things that you have to look out for is you have to understand volatility, you have to understand balanced versus imbalanced markets, and you must change your confirmation signals, you must change your stop losses, and you must compensate your emotions to fit the current conditions. In a volatile market, we might have different confirmation signals versus a market that's very balanced. And I'm going to go over some examples of trades so we know how to compensate to fit the current story. This also has to do with us adjusting our stop losses. A lot of people are like, Carmine, I'm struggling. I can't really take good setups. My entries are good, but I keep getting stopped out. Well, you have to bend, you have to adjust, and you have to adapt to fit it to the current conditions we're seeing. And the current conditions we're seeing is very low volatility, very low movement, and very, very low volume. To support this even more, if we were to look at the average volume on the S&P 500, 3.5 hours or half the session into the market open on Friday, which was March 31st, we did 760,000 lots traded compared to a daily average of about 2 million. Volume has been significantly lower. The volatility has been lower, and also if you've watched my last video, VIX has been very low, and I use the VIX. I don't have any videos on this. I don't really use it often unless the market conditions present it, but when VIX is very low, we're going to see number one be very present. Now let's go down the ladder. From the first 2 points, it's going to enable point number 3, where we see these 2 points, there's going to be less follow through and there's going to be less continuation. So it's harder to hold winners for long because there's less follow through due to the low volume and the low volatility. Now, traders that do not adapt to the current condition, maybe 2 weeks ago, 3 weeks ago, when VIX was spiking higher and there was tons of volatility in the market, there was tons of follow through, tons of continuation, and tons of volatility. Now, those same traders that absolutely killed it 2-3 weeks ago, like myself, you have to adjust to fit the current theme of the market. And the current theme that we're seeing as I'm recording this video, the start of April, is less follow through and less continuation. Now, because of 1, 2, and 3, we're also seeing not many high quality setups. So if you have a high quality to a low quality setup scale, you have to compensate for taking lower quality setups or just being very, very selective on the setups you're taking because the high quality ones have been very few and select. Now, because of this, it's okay not to trade. Sometimes being cash is a better position, and not a lot of traders can accept this because maybe 3 weeks ago, you just made the most amount of money you ever made in your life, and you want to keep that momentum going. You want to trade the same way. You're not bending your rules to fit the market, and you try to swing for a home run on a market where the market's not throwing a fastball right in the box. The market's throwing a curveball where you got to compensate at bat for it in order to hit a good hit. So it's okay not to trade sometimes. Trade only when there's a quality setup and your edge is present when you feel comfortable. A lot of people don't have confidence in this market because they don't feel comfortable. Now, that's totally fine. A lot of people still cannot accept that. If you cannot read the market, if you don't feel comfortable, or you just feel like it's best to sit sideline, then literally sit sideline, sit on your hands, or walk away from the market early. If I'm being completely transparent, last week I took 2 trades that whole week. I sat on my hands a lot. I was very, very patient, and I realized I don't have to trade every day. I saw good setups that I could have made money on, right? I mean, I'm going to go over some setups on the S&P, but I saw a ton of them that I could have made money on, but they weren't very high quality, and they weren't setups that I could have repeated and built the consistency last week to repeat that process over and over. Now, I've been trading for 7 years now, and I'm always one to stress that you have to take setups that you can repeat. If you can make money off of one setup today, but you can't repeat that process next week, next month to fit the current conditions, then there's no point of making money today on that because that's going to instill bad habits and it's going to bend your rules in the wrong way. So yeah, I could have taken more than 2 trades last week, but I opted not to because I always know the market will be here tomorrow, the market will be here next week, and I preserve my capital until I see a high quality setup that I can read properly or understand correctly. I see people taking 100 trades and each trade's not working out for them, and they're coming to me asking, what am I doing wrong? Well, you're not changing to the conditions and you're trading differently in a market that you should not be trading that way in. Okay, now that we understand all this so far, a lot of people now understanding this are not trading the proper instrument for the proper conditions. Now, if you trade options and you're doing very well with it, do not listen to my advice. I am really only trying to talk to the people who are struggling to build consistency or are just looking for another door to open. If you're watching my video and you're consistent with the strategy or keeping it the same and not changing, go for it. The market is completely complex and there's no real right way to trade. I'm only giving you suggestions on how to trade in the current conditions based off of my own experience and what I am doing to find profits and consistency. So options, a lot of people trade. They are based on many, many factors. Now, if you're a beginner trader, you have a lot of factors that you have to watch out for. A lot of people just say, okay, if I think the market's going to go up, I'm buying calls. Or, okay, I think the market's going to go down, let me buy puts. Now, you don't realize options are priced on many, many things. The 2 most influential are time and volatility. A lot of people in my messages this week have been getting the direction correct, meaning they know that the market is coming up. They say, okay, we're going to trend up today. We're bullish. We're breaking above resistance. We're pulling back into demand. I'm a bull this week. Or, okay, I'm a bear this week. That's totally fine. They're understanding the direction aspect. However, what a lot of people miss and don't even understand or know that options are priced on time and volatility. So even if you get the direction correct in the current market conditions, you must worry about the time and you must worry about the volatility. A lot of people are trading 0 days to expiration options with 3 hours left into the session where volatility is less than half of the normal average volume. That's just a recipe to blow up your account and lose your full position. Now, if it hits, it's going to hit big. I totally understand that, and a lot of people are going for that adrenaline push. However, like I just mentioned a few minutes ago, it's all about repeating that process. If you just hit 1,000% return on options, can you repeat that tomorrow, next week, consistently while still managing your risk? And the simple answer to that for a lot of beginners is no. So they can get the direction right, but they can't get the time. Also, the volatility aspect. So when you have these other factors, it's a little more difficult, in my honest opinion, to directionally trade options. Now, if you trade strategies, completely different. So because of this, futures currently, in my opinion, are the better instrument to trade because you're not basing your decision off of time and you don't really care so much about volatility. Futures, in my honest opinion, when the VIX is this low and there's not much volatility or time's really not in our favor, futures are the better instrument for everybody to trade, especially beginner traders. Just understand the risks of margin trading and understand that they are highly leveraged products. I have a lot of videos on this, and there's a full future section in the course. If you need to get educated on it, I recommend getting educated. But let's just hypothetically speak, and what I'm going to do is I'm going to buy 3 E-mini option contracts, and I got long at 4,002 and a quarter. What I'm going to do now is I'm going to put my stop loss directly below 4,096. I could have an order sitting there that if that level triggers, I know exactly how much I'm going to lose, and that's about $900 in this scenario, about a 4-point stop on 3 contracts. Now let's just hypothetically speak, and let's just say my target is around 411 and 16. I could even put a stop buy stop order up there for a target if it does trigger, but I'm going to make about $2,000 if I'm correct, and I'm going to lose about $900 if I am incorrect. The beautiful thing about futures is I know how much I'm going to win if I'm right, and I know how much I'm going to lose if I'm wrong. There's no uncertainty for time or volatility, which I cannot guess. Futures are true organic price action, not to mention they have better tax advantages as well. Now, at the same time I longed the E-mini S&P 500 future contracts, I'm going to go ahead and buy 10 of the SPY 406 calls, just saying that I trade options. Now I'm in long at 88 cents. The bad part about trading options is I cannot properly manage my risk, meaning if the S&P breaks below 4,096, I cannot really know an exact number where I'm going to stop out on the option contract. So now there's another factor, which is uncertainty about what the premiums are going to be, because the premiums are influenced by time, because I'm trading 0 days to expiration right now, which is the 31st of March on demand replay. And I don't know what's going to happen after my entry. I entered when the volume was very strong. You see this volume down here? The volume is very, very strong. If volatility dies out, my premiums are going to slowly decrease in value as we get closer to the expiration, while volatility is also decreasing. So I'm still long both instruments. The problem with my option contracts now is I'm long at 88 cents. The premiums are now going for 68 cents. So if I were to do this, I'm down 22% of this option position where it costed me only $800. I'm down off of that $800. I'm down $200 in a loss. And the market, if I were to show you the E-mini contracts, which SPY is a complete identical reflection of the E-mini, is we're moving sideways and my stop loss never triggered, and I'm only down 2 points on this. So the market's moving sideways. We're getting closer to expiration. The volatility has completely died out after our spike, after our entry, yet our future contracts, yes, we're down 2 points on this, but time or volatility is not affecting our position. So on this consolidation before eventually breaking out, we were at most down 4 points. Now, if you do the math on one contract, 1 point is $50. So at most, we were down $200 per contract. Whereas if we were trading the options, we were down 22% of our full position. Now, fast forward to the breakout, we start pulling back on the futures. Now, if you notice, the futures are at 4,004, let's just call it, and this would have to update for my P&L to update. We're about 4,004, we're up about a point, so we're net green on this position. However, due to the conditions on the options, look what the options are at now. We're at 80 cents from an 88 cent entry. We're technically down on the position of the options, yet we're still green on the position if we trade futures. Futures are true organic price action, and you do not need to worry about anything else other than price. So with the current conditions, in my honest opinion, futures are better to trade than options if the volatility is lacking like we've been seeing. Now, how I plan to trade moving forward is I plan to scalp quick micro moves in the market, it's much easier, in my opinion, to get 10 points 2 or 3 times per day, whereas maybe the range is like 40 points or 50 points. It's easier to get 10 points or 5 points multiple times than it is to take one trade and try to get 50% or 70% of the full daily range. So because of this, I'll be going with larger size. I'll be taking profits faster. I will not be looking to catch a larger move unless the conditions and the context intraday fit that. And I also have a tighter stop loss, and I'm really going to pinpoint my entries based off of order flow data. If I'm getting long something, I want to make sure other people are getting long before and after me. The other way to trade this, which personally I'm not 100% interested in, is trying to get larger time frame trend trades. Meaning, let's just say we buy on a Thursday before the dip, and then we sell maybe the next morning when we're coming up into supply or into demand or something like that. Those are larger time frame trend trades. Could be intraday, could be holding overnight. I'm not so keen to these. I'd rather get 10 points or 5 points, maybe 3 or 4 or 5 times a day than trying to get a larger move just based off of how I trade. But that's pretty much how I'm looking forward to trading for the upcoming week. And let's just see what happens. Let's see if there's volume, volatility, momentum, VIX, and let's see what price does. I will say one thing. If you develop a deep relationship with price and volume and you understand market context, you can survive and you can build consistency and not struggle in any market condition. The best skill a trader can develop is a relationship with price and volume and understand the mechanics behind the market and the context fitting the current story. So I'm going to leave you all off on that note. Drop a like, comment if you have any questions, and definitely check out the links in the description below. Peace out.